Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend, James Anderson from SDBullion. Welcome back, sir.
Thanks for having me, guys. It's good to be back.
So the latest news I wanted to get you on to talk about is the Silver Institute and Metals Focus. They've put out their latest annual report. You know, they do this annual report about where the market stands, what, production, supply, demand. And this is the Reuters article sort of summarizing it. And the headline, it looks pretty bullish. Silver heads for biggest deficit in decades, Silver Institute says. So you've been all over this, taking it apart. What's your take on this whole thing?
So it is, somewhat bullish because there's been no talk of this, as far as I know of, in the mainstream financial media until this past week when Silver Institute published this. I mean, most people who follow it week to week, month to month, day to day, like we do, we kind of knew this was already happening. But this is the first time I've seen it in the public sphere, broadcast so loud and clear and obvious. So it's bullish in the sense that it's getting more and more people who are interested in investing in general to at least think about silver in the fundamentals. I mean, obviously, we can laugh about fundamentals because fundamentals truly don't seem to matter ever in this market. But there is a time when it will, and it happened in 2008, 2011 run, and it's setting up to likely happen again. We can go through how that works, but yeah, it's for them to say it's not happened in decades. And for people out there who are looking in commodities and thinking about the commodity space, which I think a lot of people are starting to rotate into, at least the big money is, to have silver on the radar is something worthwhile, and it's something of interest. And most of those capital flows are probably going to be coming in through the ETFs. That's generally how the big money will come back into silver. And for the last 2 years, really, since Q1 2021, since the Silversqueeze really kicked off, we've had a confluence of stuff. You've had the Western ETF investors cutting their losses and selling and running, that silver getting sucked out and going into industry and into physical stackers piles and into India. So it's this weird thing. What I'm waiting to see is what happens when the ETFs have inflows for 2 years straight and the demand continues, momentum running into it. And I think that's when spot price starts really running up walls.
Well, here, I'm going to put this supply chart, supply demand. This is the data they're showing, comparing 2021 to 2022.
Yeah.
And mine production, they say, picked up a little with, mine production has been trending down from 900. It was 900 million back in 2016, but this was there was a lot of COVID halts in 2020 and 2021. So we're picking up a little from there, but the trend going forward beyond 2022 is probably back down on mine production. But the key changes here are on the demand side. Yeah. Total demand in 2021 was just around 1 billion. Now it's up to 1.2 billion. So 16% more demand. And where was most of that? Well, the biggest changes were, in net physical investment demand. This is us, right? The coins and bars. And is ETFs in this category also?
Toward the bottom, but I mean, that alone has been able to mask and keep spot price in check. The fact that you've had all that bullion being pulled out of ETFs, going off to India and going into stackers piles, that's what's really allowed it to happen without affecting the spot price as much.
So this means in 2021, the ETFs added 65 million. Yeah. And in 2022, the ETFs subtracted 110 million.
Yeah.
Mm-hmm. And that's mostly SLV being drained by the authorized participants or things like that, right?
Yeah, correct. It's investors cutting their losses, selling those shares, and then the APs probably pulling that silver and shipping it off to India or whoever else was the highest bidder. And there's Comex warehouses that have been pulling it too to remanufacture it into private mint rounds and bars, et cetera. So that all this has kind of led into this situation where you had a deficit that's forecasted to be 194 million ounces in 2022. And I have to go back. I would think you have to go back to the 1990s, like 95, 96, 97, for it to be anything close to that, where we had a deficit of this size in 1 year's time frame. And that was back when Warren Buffett and Berkshire Hathaway were draining the Comex over a couple of years time span in order to get their position. So it's been a long time.
Here's what jumps out at me. total demand is up 16%. Total supply is, roughly flat, barely moving. And average price is down 16%. So demand's up. Okay, supply is flat. Demand is up 16%. Price is down 16%.
Right.
Something's not adding up here. I mean, this is weird.
Yeah, I mean that always goes back to the actual spot price and what dictates the price movements on the Comex mainly day to day, and the derivatives really running the show in terms of day to day price action for long time spans until eventually you basically run out of the amount of registered or silver that comes out of Comex or the amount of float that's in London that can actually come out. Then you have a situation where buyers have to go out and find it on the spot market, and that's when spot starts running up walls in terms of having to literally go out in the spot market and buy it directly. That will change the spot price very quickly and make it go up a wall.
Well, here's Michael's latest chart from just a few days ago on the 17th, where this is how much silver has exited Comex since we started this process back in February of 2021. And right now we're at 102 million ounces drained. Also, LBMA has been drained by, I think, 100 million ounces or in that ballpark.
It's been more than that, Jim. I was looking today just because I looked. The Silver Institute, the combination of the Comex and London stated that 400 million ounces have been drained this year. Okay. And so it's like, I mean, they say in the Reuters article that they mentioned London and Comex losing a quarter of their entire warehouse this year. That's,
here's that paragraph is the combined Comex and London bullion market has fallen by 370 million ounces or 25% this year. But here's a stupid line. Is this now who's Newman? Is he with Metals Focus?
Yes, he's the guy. Okay. He pours water on it at the end of the article.
Oh yeah. So they still have sizable stocks. I don't think this is a concern. It's like, seriously? We have a deficit of 370 million ounces, 25% of all. And remember, a lot of the hundreds of millions of ounces that are in the Comex vaults and in LBMA are not available. They're long-term owners. There's where people just park it there. It's not available for trade. It's not available for exit. It's not for sale. Some people just park it there because it's convenient because of the huge size they own.
That and the combination of the double counted ETFs. A lot of times London will report their amount, Comex will report their amount, and they're double counting hundreds of millions of ounces sometimes from SLV, both at the same time.
Okay. So I guess the point I'm trying to make here, and of course I'm bullish and I'm not remotely objective, or I'm completely biased in my opinions here, but it seems like something's going to break eventually in this process, and we just keep buying, right? We just just keep if they want to be stupid enough to sell it to us in the low 20s, just keep taking it, right?
Yeah, exactly. I mean, the question is, what's going to be the turn, the pivot? Is it going to be the Federal Reserve? Something breaks in the system? I don't know. Is there going to be some deflationary shock? All of a sudden you have spot price go down, maybe because of some deflationary process. But the central banks are going to come back in and do what they always do, which is create more currency. And so what you end up seeing is something akin to what happened in 2020 with the COVID drop in spot, and then it rebounded quickly and ran to 30. So you're standing at 21. What's the downside risk currently versus the upside? I mean, for me to see silver spot price next year, threaten 30 and break it, I think is possible, very possible next year, especially with these bullish fundamentals that we're discussing.
Well, the other thing we're all waiting for is the Fed, of course, to stop raising rates. They're hinting that at the December meeting they're going to do 50 basis points, and at that point, I think they're hinting in their language that they've caught up to where they need to be. Any future rate hikes will only be 25 basis points or so. A lot of people think they're going to stop around 4.5% or 5% and then stop. And that's the quoted pivot. That'll be the peak in the rate cycle. And at that point, once we know they're no longer raising rates, then gold and silver take off is the theory.
You would think that the capital inflows when that happened, in terms of like big money going into ETFs and ETFs becoming, net buyers of silver and not net sellers like they've been the last 2 years. Those two forces, you got India still buying, you got all these stackers out there still buying, and the internet helping people learn this information. So yeah, I mean, you got a bunch of factors that could mix for bullish scenario for silver. So I agree, Jim, and it's probably only a few quarters away.
Well, anyways, thank you very much for joining us to go over the Silver Institute report. We appreciate it. And what are you seeing right now with premiums out there? I mean, you work at SDBullion.
Sure.
Are there any specific coins that are, or bars that are most reasonable premiums at this point?
Yeah, I mean, anyone who's been paying attention in premiums last few years have realized that the Silver Eagle has basically become a collectible. It's not really a bullion product anymore because it's not even priced remotely near.
What are they going for? 35, 40?
Yeah, 35 to 40, somewhere in there. And,
so
dealers
almost
are buying
75% premiums or 100% premiums.
Dealers are buying them back for 10, 11, 12 over spots. So yeah, there's a bifurcation there. If people are out there and they're thinking about buying bullion, you want to find bullion products that are closer to spot, I think, and hallmarks that are well respected and have good, solid two-way, bid-ask spreads. So you want to get products where you could sell them to any dealer that you choose, and that are well respected by the public at large, and try and keep it reasonable within a few, $3, $4, $5 within spot. And I would think you're going to make up that difference pretty quick next year with all these things that we've discussed. So yeah, the premiums have gone down just a little bit lately, and I think as long as spot stays at this range, we'll keep seeing premiums go down a little bit. But if spot falls, if it falls dramatically, or if it starts rising and you get momentum runners in here, then premiums will probably stay put. But as long as it stays in this sideways channel, you're going to have to cut premiums in order to get some revenue, and that's what I'm thinking is going to happen for the next quarter or so.
Yeah. Well, thank you very much for an update, and we'll definitely check in with you again in the next 3 or 4 months.
All right, guys. Pleasure.